You know that feeling, right? Popping into the dollar store for just one thing, or maybe finding that unexpected bargain. These stores, they're just part of our everyday landscape. But what if I told you that behind those simple green signs, there's this incredibly complex world? High stakes finance, big strategic shifts, and it's all happening right now. Today, we're doing a deep dive into Dollar Tree Inc., a name everyone knows. They've just put out their Q2 fiscal 2025 reports. Our mission here is to really unpack the numbers, get a handle on these huge changes they're making, and figure out what it all means. For them, sure, but also for you, the person shopping there.
Exactly. We're looking at their second quarter results, the ones ending August 2nd, 2025. But it's more than just the numbers. What's really interesting is how they connect to this big strategic pivot they're making, especially after selling off a major part of their business. It tells you a lot about where they're heading.
Okay, let's get into these Q2 results then. What's the headline story for you? What jumps out immediately from these figures?
Well, the first thing you see is the adjusted diluted earnings per share, or EPS. It came in at 0.77. Now, that's a solid beat compared to what analysts expected. But you need to know that number got a boost, about $0.20, from some tariff timing effects.
Tariff timing. We'll come back to that.
Right. And net sales, up a pretty remarkable 12.3% to $4.6 billion. So it's not just growth. It shows they're, actively managing these external pressures, like tariffs. They have a pretty sophisticated team handling that.
Okay, that $1.20 boost from tariff timing, it's not just random luck, is it? Sounds like some smart planning. Can you break that down a bit? How does that work?
Yeah, it's definitely not luck. It really shows how they're navigating global trade.
Mm.
Think of it like playing chess with import duties. They anticipated the impact of tariffs and found ways to mitigate it financially, probably through timing purchases or negotiations, before it hit their bottom line. It shows real agility in their supply chain.
Right, being proactive, not reactive.
Exactly. And that kind of operational strength is, frankly, something a lot of retailers would envy. It gives them flexibility.
And that kind of financial strength, that flexibility, it probably empowers them to make bigger moves, right? Which brings us to maybe the biggest story here, the big breakup they actually went through with selling the Family Dollar business. What was the thinking behind that? Why split up now?
It's a huge strategic pivot, no doubt. The sale closed July 5th, 2025. They got about $1.0 billion for it, which translates to roughly $800 million in net proceeds after everything. Their CEO, Mike Creedon, he put it plainly. He said it lets them become a fully focused business.
Fully focused.
Yeah. The why is pretty clear.
Yeah.
Get rid of the complexities of running two different banners and pour all that energy, all those resources into just the Dollar Tree brand.
Huh.
Streamline everything. Concentrate on that core identity.
So Family Dollar is off on its own now, but it wasn't like flipping a switch, right? I heard there's still some connections, some financial ties.
You're absolutely right. It's more of a structured separation. They've got these transition services agreements in place for up to 18 months.
Okay.
So Dollar Tree is still providing some operational support, IT, supply chain help, things like that, to Family Dollar to make sure it's a smooth transition.
Makes sense.
And financially, Dollar Tree gets some pretty significant tax benefits from the sale, estimated around $425 million from the losses recognized. That's a nice cash cushion. Plus, they're guaranteeing leases for about 121 Family Dollar stores for the first year. That's about $91 million initially. And covering some supply chain finance stuff for 90 days.
So temporary support.
Exactly. It's a carefully managed uncoupling, beneficial for both sides during this period.
Okay, a thoughtful uncoupling, not just a quick split. So now with this laser focus on the main Dollar Tree brand, how are the actual Dollar Tree stores doing? Comparable store sales up 6.5%. That sounds pretty good. How'd they manage that?
Yeah, 6.5% is definitely solid growth for existing stores. It came from two main places. First, customer traffic was up 3.0%, so more people walking in.
Right.
And second, the average ticket, how much each person spends, was up 3.4%, so more people spending a bit more each trip.
A good combination.
It is. And what's really interesting is their discretionary sales, the non-essential stuff, had the best comparable growth since way back in Q4 2022. It hit 6.1%. That actually outpaced consumables, which were at 6.7%. It suggests, maybe shoppers are feeling okay about grabbing those little extras, or maybe Dollar Tree's merchandising is really hitting the mark.
That's fascinating. People aren't just grabbing necessities. So more traffic, higher spend, broader purchases. But did it translate to profit? How did the gross margin look with all this volume?
It did, mostly. Their gross margin actually expanded by 20 basis points. It reached 34.4%.
20 basis points, so 0.2%.
Yep, right. Sounds small, but for a company this size, that's millions hitting the bottom line.
Yeah.
The main drivers were better mark-on from their pricing changes, basically, a better initial profit on goods. Also, lower domestic freight costs helped a lot. And getting more sales through the same stores reduces occupancy cost per item, that's sales leverage.
Okay.
And the mix helped to slightly fewer low-margin consumables as a percentage of total sales. But it wasn't all easy. They still faced pressure from higher tariff costs, more markdowns needed to move inventory, higher distribution costs, and, shrink, theft, and damage.
Ah, shrink. Always a factor.
Always. So it's a constant battle. But yeah, overall gross margin improved slightly.
Okay, gross margin up. But then I look further down. The
Yeah.
adjusted operating margin actually went down 20 basis points to 5.2%. What happened there? Cost creeping up.
You nailed it. That dip comes from higher SG&A selling, general, and administrative expenses. We're talking higher store payroll. Partly from the work involved in their pricing initiatives, but also just necessary wage increases to stay competitive. Plus, more depreciation because they're investing a lot in their stores. Higher incentive compensation, more store maintenance. It adds up.
Right.
Now, some things offset it a bit, like lower general liability costs and that sales leverage we mentioned. But yeah, the expense increases basically canceled out the gross margin gain when you look at operating margin.
So investing in the business, in people, in stores, which costs money up front.
Exactly. It's that classic trade-off. Investing for the longer term, even if it slightly impacts the margin right now.
Makes perfect sense. Spend money to make money eventually. So with all of these moves, how are they doing against competitors? Are they gaining ground, especially on those essential items? And are the stores themselves getting more, productive?
Good questions. On market share, yes, they're showing really strong gains in consumables. Their dollar sales volume in that category was up 7.9% compared to last year, and unit volume up 4.7% in Q2. That clearly says they're taking share from others in everyday essentials.
Wow. Okay.
And on productivity, sales per square foot are up too. It's now $237 for the last 12 months compared to $235 a year ago. Not a huge jump, but it shows they are getting more sales out of the same space. Better efficiency.
Which is key for a value retailer, right? Every square foot counts.
Absolutely crucial.
So they're definitely leaning into strengthening the core Dollar Tree stores. What about growth? What's the strategy for expanding their footprint and trying new things? I know they've been testing different formats.
Oh yeah, their real estate strategy is pretty dynamic right now. It's got several parts. First, just opening new stores. They opened 106 new Dollar Trees in Q2. That brings the total count to 9,148.
9,000 stores.
Yeah, it's a big network. Second, they're actively converting some of those former Family Dollar combo stores entirely over to the Dollar Tree banner. They did 26 of those in Q2 and plan another 31 by year end.
Okay, standardizing the brand.
Exactly. But the really big shift, the one that gets a lot of attention, is converting stores to their 3.0 multi-price format. They converted another 585 stores in Q2. Now over 4,240 stores have this format.
Over 4,200. That's almost half their stores, isn't it?
Getting close, yeah. It started with adding $3 and $5 items, but now it includes frozen food, refrigerated items, other consumables, all above that traditional $1.25 price point.
So moving beyond just the dollar.
It's a direct response, they say, to customers wanting more value and a wider selection. It's really an evolution of what Dollar Tree is.
That move to multi-price, it obviously gives customers more choice, which seems good. But doesn't it risk, confusing people? The name is literally Dollar Tree. Is there a danger they might alienate those core customers who come only for that $1.25 bargain?
That is the multi-billion-dollar question, isn't it? It's a tightrope walk. The risk of diluting the brand, the core promise, is definitely real. But Dollar Tree seems to be navigating it quite carefully. Their data, what they're seeing in traffic and sales, suggests customers are buying into it. They see it as added value, more options, not necessarily a betrayal of the dollar concept.
Interesting.
The key is probably communication, positioning it as more value, more choice under one roof, rather than just higher prices. It's a calculated risk, for sure, but the numbers so far suggest it might be working for their specific customer base.
Okay, a calculated risk that seems to be paying off for now. Speaking of risks and challenges, I remember hearing about that terrible tornado that hit their distribution center in Marietta, Oklahoma last year. That must have been a massive disruption. How did they handle that?
Oh, that was a huge blow. The Marietta DC was completely destroyed back in Q1 of fiscal 24, a major test of their resilience. The good news is the financial loss is about $129 million for inventory and the building were fully insured.
Okay, that's good.
But operationally, They had to scramble. They actually converted two Family Dollar distribution centers, one in West Memphis, one in Odessa, Texas, to handle Dollar Tree inventory instead.
Wow, repurposing assets quickly.
Right. But that switch incurred extra costs, and those costs are actually still having a bit of an impact on their gross margin even now. Shows you how long these disruptions can echo.
Yeah, the ripple effect.
But they're not just patching it up. They are committed to rebuilding in Marietta. A new, bigger, better distribution center is planned to be operational by spring 2027. It'll serve around 700 stores. So it shows resilience, yes, but also a long-term investment in making their logistics network even stronger. It's like turning the disaster into an opportunity to upgrade.
That's impressive, rebuilding stronger. Now, besides acts of God, there are those man-made challenges like tariffs, always seem to be hovering over retail. How are they managing that ongoing pressure?
Yeah, tariffs are a constant factor. There were new ones announced back in Q1 that affect imports from various countries. For a company like Dollar Tree, sourcing globally, that's a big deal. So they have a whole playbook of mitigation strategies. They're negotiating hard with suppliers for lower costs. They're strategically shifting where they source products from, moving production to countries not hit by specific tariffs. And, as a last resort, they might adjust the product mix or even tweak prices slightly. They expect some choppiness, some cost volatility in the second half of this fiscal year because of it. But the point is, they're actively working to protect their margins and stay competitive. It's about adapting to that shifting global trade environment.
So, constantly adjusting the sales. Okay, beyond the supply chain fixes and tariff navigation, what else are they investing in? Now that they're this fully focused Dollar Tree, where are the big bets for the future?
With that sharper focus comes a pretty broad investment plan. First, they're putting money into their people, competitive wages, better training. The idea is that helps both the employees and the customer experience.
Makes sense. Happy staff, happy customers.
Pretty much. Then they're optimizing and modernizing the stores themselves through renovations, keeping things fresh. And a big one is technology. There's a multi-year plan to upgrade their mobile app, their internal HR systems, human capital management, and definitely their supply chain systems. All about efficiency and better customer connection.
Tech upgrades, okay.
And here's a really interesting one. They just announced a new nationwide partnership with Uber Eats.
Uber Eats for Dollar Tree.
Yep. On-demand delivery from nearly 9,000 stores. It's a huge leap into the convenience delivery market. Talk about meeting customers where they are now.
Wow, that is surprising. A dollar store on Uber Eats. Definitely a sign of changing times and trying to capture a different kind of shopping trip.
It's a bold move for sure. Very strategic.
Okay, so pulling all this together. Strong Q2, the big family dollar sale is done. They're pushing multi-price, investing heavily. What does this mean for the rest of the year, fiscal 2025? What's the outlook?
Their updated forecast for the full year, just for the continuing Dollar Tree operations, looks pretty confident. They're projecting net sales somewhere between $19.3 billion and $19.5 billion.
$19 billion, okay.
Comparable store sales growth expected between 4 and 6%. Adjusted diluted EPS forecast is in the range of $5.32 to $5.72. And they expect gross margin for the year to be up about 50 basis points, so 0.5% improvement. Plus, planning around 400 new store openings on top of those combo store conversions.
So they're projecting continued growth and improved profitability for the core brand. Sounds optimistic.
It does. It signals strong belief in this focus strategy.
Now, you mentioned that $1.20 EPS boost in Q2 from tariff timing. Is that going to repeat in Q3, or is that a one-time thing?
Good question. No, they were very clear about this. They're specifically forecasting that the positive timing impact from Q2 will actually reverse in Q3.
It reverses? Okay.
Yeah. So they expect their Q3 adjusted EPS to be pretty similar to last year's Q3. It's basically that temporary gain normalizing out. Important context, so you don't expect that specific boost going forward.
Right, managing expectations. Got it. Beyond the operations, they've also been active buying back their own stock, haven't they? What's the story there, and what does it say about their financial health?
Yes, very active. In Q2 alone, they bought back 5 million shares for about $501 million. That brings the total for the year so far to over $1 billion in share repurchases.
$1 billion.
And the board just topped up their buyback authorization, putting it back to $2.5 billion available. That's a massive signal of confidence from the leadership in the company's value and future.
Definitely sounds like confidence.
They also paid off $1.0 billion in debt that was coming due using cash and commercial paper. They still ended the quarter with a solid cash position of $666 million. And one other interesting financial footnote, there's this new tax law, the One Big Beautiful Bill Act, or OBBA. They expect it will let them defer about $100 million in federal income tax payments this year.
OBBBA. Okay. More cash flexibility.
Exactly. It all paints a picture of a financially disciplined company managing its capital well and signaling strong belief in its own path forward.
Wow. It really has been quite a journey digging into Dollar Tree. You start thinking about just grabbing cheap wrapping paper, and suddenly you're talking about billion-dollar divestitures, multi-price strategies, global supply chain resilience. It really underscores how much complexity and strategy sits behind even these seemingly simple, everyday stores.
It really does. That sale of Family Dollar marks such a clear shift, a deliberate narrowing of focus onto the Dollar Tree brand itself.
Hmm.
I guess the big question, at least for you, the listener, to think about is this. How will this sharper focus, combined with pushing beyond the dollar price point and investing so much in logistics and tech, how will all that ultimately redefine what value means when you walk into their store, especially as the economy keeps changing around us?